So in this video I'm going to show you some practical examples of how tax-free cash works. We'll also look at the taxable element as well and look at the relationship between the two. I'm also going to give you 3 examples of how you can take your income from your personal pension. Your personal pension we know is accessible from age 55, that's going up to age 57 from 2028. So I'll give you some examples of how you can actually take that income from your personal pension, and then you can have a think about how that relates to your own taxable position, and I'll also give you some examples of those tax bandings as well, and how that taxable income from the personal pension will sit within those tax bandings. And that's also something you want to be thinking about when you're deriving your income from your personal pensions in conjunction with any other taxable income that you might have as well. I hope you find it useful. Thanks. So let's start at the beginning with our lovely little personal pension pot. 25% of it will be tax-free cash. The remaining 75% is treated as taxable income. Now, as way of an example, let's say the pot is £100,000, then we know in terms of tax-free cash it's going to be 25% of £100,000, which clearly is 25,000. If the pension pot was 200,000, then clearly the tax-free cash, again, always as a percentage, 25% of that is going to be £50,000 of tax-free cash that's available from the pot. Now, when we start off, our personal pension pot is what is known as being uncrystallized, in that we haven't taken any benefits from it at all. It hasn't been tested against the lifetime allowance, and no benefit crystallization event has occurred. So this is what's known as an uncrystallized pension pot. Now, one of the key benefits of Flexi Access Drawdown is that flexibility around how you take those benefits. And the key reason why it is beneficial is because of that ability to amend and adapt the withdrawals in line with your tax position. So let's say we've got our taxable income. Let's give an example of this. Let's say we've got a total taxable income of £60,000. So it's pretty good retirement income. We know that at 12,570 of that falls within our personal allowance, and therefore if our taxable income falls within our personal allowance, then that money is effectively no tax is payable on this portion of our taxable income. Another band is 50,270, which is the point at which we cross over into the higher rate tax band. So any of our taxable income that falls within this portion here is going to get taxed. Anything above 50,270 is going to get taxed at a higher rate. So if our income is £60,000, then we know the first 12,570 has zero income tax associated with it. The next band from 12,570 to 50,270 is taxed at 20%, which is 7,540. The next band, so above 50,270 to 60,000, is then taxed at 40%, which is about £3,800, which gives us a total tax bill here of 11,432. Clearly we can then work out what our net position is. We've got £60,000 gross income, we've got 11,432 of tax, which gives us a net income of 48,568. Now, where this is relevant is that when we're looking at Flexi Access Drawdown, we're thinking about how we potentially keep ourselves within these bands. So it could be that we're wanting to keep our total income within the 12,570. It could be that we're literally just wanting to make sure that we, and this is quite a common one, stay below that 50,270. Clearly, if we go above the 50,270, we know any income above that is going to get the additional 20% income tax being paid on it. So it's quite a critical point at that level. Now, for a lot of people, clearly the state pension kicks in, and it's going to be around £10,000. It's going to depend obviously on your state pension forecast. So a large chunk of the personal allowance will likely be taken up simply with the state pension, which gives you some margin here for additional taxable income to take you up to that 12,570. So next I just want to give you an example of what this looks like in practice as far as a £100,000 pension pot is concerned, and where we take out a portion of our fund by way of a tax-free cash and a taxable element of it as well. So we're looking just to take out, let's say we're looking just to take out £10,000, and we're going to do so in a fairly standard way. And I just want to give you 3 other examples of how you can take £10,000 out of your Flexi Access drawdown account in different ways in terms of either utilising the taxable element or the tax-free element. So again, we know that this portion, we've got 25% at the top here, which is our wonderful bit of tax-free cash, and the bit below is our taxable element. So what we're looking to do here is we want to take out £10,000, and we're going to take that out with a portion of this fund is taxable. So we've got 2,500 is tax-free, and we've got the remaining 7,500 is the taxable bit. And this effectively, all of this pot here is then what is known as being crystallized. And that gets paid over into our bank account. So all of this paid over into our bank account, and it's crystallized. So it's tested against lifetime allowance, and it's a benefit crystallization event. £7,500 is taxable, £2,500 is tax-free cash. What that leaves then in its place is it leaves what's known as a uncrystallized fund is then left. So we've got an uncrystallized fund here of £90,000, and this is what is known as being uncrystallized. So what that leaves us with is a pension pot worth £90,000. Again, we know that 25% of that is tax-free cash, and the remaining 75% is taxable income. Now let's assume this is a year later since our last withdrawal of £10,000, and the fund grows by a nice amount, 10%, which would take us to about £100,000. Now that means we can repeat the same process all over again. So we've now got a pension pot that's grown in value from 90,000 to 100,000, and it means we can repeat that exact same process again as far as taking out £10,000 and withdrawing that to our bank account over here. And it's exactly the same scenario. We're going to take out 2,500 tax-free and 7,500 of taxable income. So we can do that exact same process again. Obviously we don't have to do that amount, we can do different amounts. But in this example we're doing £10,000. Now the key thing here is that obviously over time, although just something to bear in mind here is that the nominal value of this fund is going to maintain itself. So let's say we in an incredibly unusual situation, we're able to grow this pension fund by 10% every single year without failure, and we do exactly that same process again and again. We take £10,000 out each year. Then in theory, that fund value will remain exactly the same in nominal terms. Now, we well know with inflation is taken into account, then in real terms that obviously that fund value is actually declining in terms of real purchasing power, but we are maintaining that value of 100,000. Hopefully that makes sense. Now I just want to show you those 3 examples, 3 different ways that you can take £10,000 out of a personal pension pot. The first way is that we actually crystallize the £10,000. So we're going to take out £10,000 from our pension pot. Of that £10,000, 25% of it is tax-free cash. And this is the fairly standard way that someone would take out an income or some money from their pension. We know that 25%, 2,500 is tax-free, and the remaining 7,500 is the taxable bit. So pretty much the way that I've shown you before on those other examples. And our second way is that we crystallize £40,000 worth of our pension. Why 40,000? Because we know with £40,000, 25% of that is tax-free cash. With crystallising £40,000, it means that we get our £10,000 out completely tax-free. What that means for the remaining 75% is then actually, this is then left. It remains in the pension and invested. So in effect, our 75%, our remaining taxable element, remains in the pension scheme itself, and it remains invested, growing in value. But clearly what we've done here is we've crystallized that amount, and it sits there in the pension until we decide to do something with it, i.e. take an income from it, which would of course be taxable. Now the final way, which allows for the greatest amount of flexibility, and is one of the ways that a lot of people will use in order to keep themselves below certain tax bands. So we'd actually crystallize 20,000, 20k. Of that 20k crystallization, half of it is going to remain in the pension. So let's break this down. We got £5,000 here, which is the tax-free cash element, 25% of 20,000. We've then got the remaining taxable bit, which is 5k here, which is taxable, leaving us with £10,000, and this 10k will again remain in the pension, but it is crystallized and it's still invested. So whatever underlying investment the pension has, it will remain in there. This portion, these elements, have been paid out to your bank account. Now this is really where you're potentially wanting to keep yourself within a certain tax band. So let's say you've got enough allowance, potentially either to take you up to the personal allowance, or it could be that it's just to take you up to the higher rate band, and so you don't go over the higher rate band, but you've got £5,000 before you go over there, then potentially this is where you might utilize this. So it enables you to take out a portion of tax-free cash and a portion of taxable income to get you to a certain level of income that you look to take without taking you over a tax band. So it's an incredibly tax efficient way of managing that. But as hopefully you can see with all three of those examples, that there really is a different way that you can use Flexi Access Drawdown to enable you to be able to take an income from the plan, ideally to suit the tax position that you are in at any given moment in time. But also just bear in mind as well the future, as far as where you might be in the future as to your tax position, as to potential taxable incomes that might arise in the future.